As a trader, you can't avoid risk entirely, but you can maximize your chances of making big profits with the right tools, data, and strategy. You'd be amazed by the tools we have access to today, and you're missing out if you're not using them. In this video, I share with you a webinar I sold for hundreds of dollars a couple months ago, in which I go everything you need to know to understand the effects of options on the market and predict price movements before they happen, so you never get trapped again. We'll cover all the fundamentals about options, Greeks, the role of market makers, how they influence the market, and how you can profit from it. This is basically a full-length options trading course for free. This isn't gonna be your basic trading video. I'm gonna be showing you exactly how to perfect your entries through options positional insights while taking less risk than ever before. Let's get into it. So the title of this course is gonna be Beneath Options, Decoding Positioning Effects for Traders. All right, I think we're all traders here and we want to understand better the effect of positioning and how we can benefit from it. So let's begin. This is gonna be the broad outline for today's presentation. So we're gonna go over the technicals of options, just some basic fundamental definitions. Then we're going to go over market makers, delta hedging, and how we can use this information to be able to play some trades, right? Applicable uses. So technicals. This section is going to be split in 3 different parts. Of course, option fundamentals. I'm just going to go quickly over that. Then we're going to go on to the first order Greeks and then positioning. So to begin with, option fundamentals. What is an option? I think all of you guys know what is an option, but let's just go over it pretty quickly. It is basically a financial contract that grants rights to owners, right? There's always a buyer and a seller in the option contract, and it grants the right to the person who buys the option to either buy or sell the underlying asset at a set price within a defined time frame, which is an expiration. Okay. So there's two types of different types of options. There's the calls and there's the puts. The call, it grants the owner the right, but not the obligation to buy the underlying. When you buy a call, usually it has a bullish outlook for the person who buys the call, right? Good. On the other hand, the put grants the owner the right, but not the obligation to sell the underlying. So when you buy a put, generally this has some form of bearish outlook. So there are different parameters with respect to an option that defines it, right? So of course there is the underlying to which it is tied. So for instance, we're going to be covering mostly SPX here. So SPX, right? So there's the underlying. There's going to be the type, whether it's a call or a put. There's going to be a strike price, all right, and an expiration date. And on the right-hand side, you can see Interactive Brokers option chain, mobile version. So on which you have different combinations of expirations, strike prices, and of course you have the calls and the puts separated on each hand. So one thing to note with respect to options is that their pricing is not linear. There is what we call convexity to it. And not only that, it is multifactorial, all right? There's a lot of different parameters that come into play that help define the pricing of an option. And we're going to dive into them very shortly. And to help compute this in a better manner, for us to be able to understand how this pricing is going to be changing, well, there are some different formulas or, Greeks, there's different formulas or factors that we call Greeks that help to describe how an option is going to change in value. All right, so these are going to be the Greeks, and we're going to dive into them very shortly. So like we can notice here, we have the pricing of an option. On the top hand side, we have the call, and on the bottom, we have a put. What we can notice is that, so just for reference, the x-axis is the underlying price. So as the underlying price is moving up towards the right, well, we have an increase in the value of the call, right? So like we said, someone who buys a call has a bullish outlook, meaning that as the underlying price is going up, the value of a call is going to be going up. Similarly, a put has a bearish outlook. So as the underlying price goes towards the left-hand side, meaning towards a a drop, well, the value of a put is going to be increasing. Right? But one thing to note, I kind of circled it very subtly in yellow. You're going to notice that it is not linear, right? There is some form of curve. And that curve is extremely interesting and important in the world of options, right? This is the fundamental of everything that is going to be coming up after in this presentation. So it is not linear and it has some convexity. So there's these guys, Black, Scholes, and Merton. They made this famous formula. They won a Nobel Prize for it. So let's just be clear here. This is not a calculus class. Okay, don't be scared. Don't be. This is just for reference. All right. So this is the Black, Scholes, and Merton. This is one of the most accepted options pricing model, and we're going to be using it to be describing the different characteristics of an option pricing. So looking at this formula, there are different parameters that come into play to be defining the pricing of an option. So first of all, there are the parameters that define the option: the strike price, the contract type, and of course the underlying, which is SPX here. So the strike price is defined and it is static, right? You cannot change the strike price of a contract midway, right? The contract type, a call is always going to be a call. It's not going to switch to a put, right? So this is defined and static. So now we have different other parameters that are somehow static during a trading session, which is the risk-free rate. So it is defined and common for every single option contract, right? The risk-free rate is common. However, it can change a bit, but generally it is static during a trading session. And of course, the dividend, it is static for the SPX as there is no dividend. And for instance, for a stock, for example, it is going to be static during a trading day unless the company announces a new dividend rate. However, there's three different parameters here that are extremely dynamic and have a very important factor in determining the pricing of an option, which is the underlying price. The underlying price can move a lot during a trading day. Also, the time to expiration, times always moves, right? I think so. Time always moves forward. And this is dynamic for every single contract. This is common for every single contract. So the underlying price is impacting all the option contracts. The time to expiration too. These two elements are defined and dynamic. And the other one is the implied volatility. Every single option contract has a unique individual value of IV. Right? So this is not necessarily defined and set. Right? Also, it is very dynamic. Okay, the IV of every single option contract can be changing during the trading session. Before we move on, there is a question here. Is there a link to PowerPoint so we can take notes on our devices? Let me check here on the platform if there's a way for me to share. Hold on. Yes, we are now. Does everyone hear me properly? I feel like there's some people who says that the speaker is getting ready.
I do hear you properly, so I hope
Yeah,
maybe you
so-
just can confirm that.
okay, everyone hears, but the silence is not hearing us. Maybe try to refresh the page. Everyone seems to be hearing us properly here. Yusuf, could you try to just share the PowerPoint to everyone while we proceed?
Yeah, sure. Let me do that.
Great. Wait, let me send you the PowerPoint. Hold on. Okay. It works on the web, not on the app. That is strange. I'm gonna contact broadcast about this. Um, all right, we're gonna proceed. So we just went over the different factors that is going to be impacting um, the options pricing, and the three in red are extremely dynamic during a trading session. So to understand options, they have an intrinsic and an extrinsic value, right? So the intrinsic value is characterized by explicit market conditions. For instance, you can take a call, for instance, with a strike price of 100. If the underlying price is 110, well, there is a $10 value tied to this contract, right? Because this call option grants you the right to buy the underlying at 100. And if the current underlying price is 110, you could directly make a $10 profit. So there's a $10 intrinsic value. However, different parameters work together to give some form of extrinsic value to an option. For instance, if the underlying is extremely volatile, well, having this option can act as a form of insurance, right? So IV is going to play an important role in determining the extrinsic value of an option contract. Time to expiration too, right? Also the risk-free rate. So different parameters will be playing together in pricing the option and giving it some form of extrinsic value to the option contract. So going over IV, right? Each contract, like we said, has independent value of IV. So sometimes people are going to be saying, right, the IV is going up, the IV is going down. So brokers will be having some form of formula to be representing the overall implied volatility of the entire options chain. However, this is somehow of a kind of mathematical gymnastic because in the essence, every single option contract has a unique implied volatility value, right? And this is referred as the fixed strike volatility. And it is in a way measuring the expensiveness of an option contract. So for instance, let's just take an example, right? If a customer aggressively buys a contract and drive the price up. So let's not forget all the parameters characterizing the options price are defined, right? So the underlying price, the current time, whether it's a call or put. The only one that is not set, right, is the IV. So in that case, if the options pricing is becoming more elevated, well, in that case, the IV in the Black-Scholes model, right, the IV has to rise to explain this increase in the options price, right? So on the other hand, if ever customers aggressively sell a contract and drive the price down, well, all the parameters characterizing the options price are defined, but the IV, like we just said, and in that case, the IV will be dropping, right? Um, Another example is for example, CPI is coming, right? There is more uncertainty about the underlying direction. And like we said, like we discussed, options, they act as a form of insurance, right? So the perceived value of these options is going to be increased. So in that case, not only people are going to be buying more options, but also the perceived value of the option is going to be increased. So in that case, the IV is going to be increasing. And this is why generally we have more expensive options ahead of major economical events or earnings for stocks, right? We're going to have more expensive options and a rise in implied volatility. So we can understand that IV is not just a measure of the, it's not necessarily a measure of the underlying volatility. It is the implied volatility from the options price, right? This is why we call it the implied volatility. The the volatility of the underlying is just how much it moved, right? So it's a measure in some way of the supply and demand of options. It factors in the underlying volatility. It's overall the expensiveness of an option. So as a recap, options are contracts. They're financial contracts that grant the right to buyers to either buy or sell the underlying, whether it's a call or a put. They're defined by parameters. So the underlying asset, SPX, Apple, whatever stock, the type, is it a call or a put, the strike price, and of course the expiration. The pricing of options is not linear and it is multifactorial. So the underlying price, time to expiration, and IV are dynamic, very dynamic during a trading day. It has intrinsic or extrinsic value, and it can measure, and the IV measures the expensiveness, the relative expensiveness of an option. We're going to be diving in the Greeks, the first order Greeks. So for instance, delta, theta, and vega, right? So delta, what is delta, right? Delta measures the price sensitivity of an option with respect to a change in the underlying. So calls are going to have a delta between 0 and 1. Puts are going to have a delta between -1 and 0. Okay? So for instance, a call option with a delta of 0.5 means that the option's price will be increasing by 50 cents for every $1 increase of the underlying asset. Okay? It's just a representation of how is the options price going to change with respect to change in the underlying. Okay? So it's simply the derivative. So the delta is basically the slope of the options price, right? So how is the price of the option changing? The slope is going to be the delta. It will be representing how the delta is changing with respect to the change in underlying price. So the delta is just the slope of this graph. We can understand that delta cannot be greater than 1 for a call, and it cannot be inferior to -1 for a put. The value of an option cannot fluctuate more than the actual underlying. It wouldn't make any sense, right? Imagine having a call on Apple. Apple, let's say it costs $200, right? If Apple moves to 202, you cannot make $3, right? If the underlying moves by $2, the maximum amount you can make with your call option will be $2. It just doesn't make any sense to make more than the actual underlying. Wait, some people are having trouble with the PDF.
For those who can't access it, please write down your emails. I'll be sending the PDF to you via email.
So if you guys have any question, write them down in the Q&A section, and we will have a little moment after each section where we will be answering the questions. So just put them in the Q&A section so that we can keep track of the questions as the chat can move pretty quickly. All right. Yeah, I think pretty much everyone is not working. Okay. Well, I'll continue with the presentation, and Youssef is going to be sending you the email shortly. So just to make sure to put your questions in the Q&A rather than the chat, because the chat, we might lose your question. Okay. So like we said, the value of an option cannot move more than the actual underlying. Okay. And I think it makes sense. So like we said, delta is the derivative. It is the slope, right, of the options price. So for a call, like we said, the value of a call always increases as the underlying moves forward. So it is logical that it is contained between 0 and 1. It is always positive. Whereas a put gains value as the underlying price is dropping. So it is logical that the value of the delta of a put is negative, contained between -1 and 0. We also notice something very interesting is that the greater we approach the expiration time, the greater that change in delta becomes significant, drastical, right? So here, HTE stands for hours till expiration. And at expiration, basically, we just get this binary where the delta moves from 0 and 1 for a call and 0 to -1 really quickly for a put. Right. So another way to see it, but this is for some of our friends that have a more of a statistical approach, it could be seen as the probability of landing in the money at expiration. So if we just take example here, at expiration, if you're if the option is in the money, right? Basically, the probability of it landing in the money is 100%. Is one. The further we are away from the expiration, well, the more chance that the actual underlying moves and the option ends up not being in the money. So that's just another way to visualize it, but it doesn't necessarily change our approach of understanding the delta. This is just another way to see it. Theta. So what is theta? Theta is simply measuring the rate of decline in the options value over time. So it indicates the daily price decrease of the option as the expiration approaches. For example, an option with a theta of minus 0.5, the value of the option is going to be decreasing by 50 cents every day. Okay. So we can see here that all options decay. Right. So in the money call on the top left, the value is going to be decreasing over time. At the money options too, right? Out of the money calls. So every option will be having some form of decay. You see that all the slopes are moving towards the downside. All the slopes are negative, right? So this is theta. Theta measures the decay of an option over time. And we're going to notice that the effect of theta is amplified, like we said, at the money. Right? So theta is highest for at the money option, and time decay accelerates as we near towards the expiration. So every option, long options, have a negative theta, meaning that their value is decreasing over time. Short options, well, is the opposite, right? So they have somehow a positive delta if ever you're on the opposite hand. And of course, the underlying has no decay, right? The underlying is the underlying. There's no decay. So like we said, every contract decay and they lose their extrinsic value as we approach the expiration. Vega? What is Vega? Basically, Vega simply measures the sensitivity of the options price with respect to the IV change, right? So it reflects, so the value of Vega is simply the change in the options price for every 1% change in IV. So a rise in the respective fixed strike IV of this contract, right, for instance, will be having an increase in the options price, right? So we're not speaking of the VIX. VIX is a different formula that we're not going to get into it in details, but VIX is not necessarily a reflection of your specific options IV, right? It is a very complex formula that encompasses multiple different options in the SPX. So Vega has a positive relationship with an options price. So as the IV increases, the cost of an option increases, right? The price of the option increases. Like we discussed previously, right? It is like the missing piece of an options pricing. Every other element is fixed and set as a market in the market conditions. As the name says it is the implied volatility from the options price. So generally, the IV is going to be rising when there's a potential high volatility event or some form of volatility will be expected in the underlying, as these options, these contracts are going to be more valuable. When you're long options, you're long IV, right? Because as IV increases, your options are going to gain in value, and the opposite, if IV drops, your options positions value might be dropping if you're long options. So a visualization. So on the left hand side, you have the options price, and then on the x-axis, you have IV, right? So we see that for every single type of options, whether it's an in the money call, at the money call, out of the money call, same thing for puts. As the IV is increasing, the value of the option is going to be increasing as well. So just a little recap. Delta represents how the options value changes with respect to the underlying price. It is positive for a long call and negative for a long put. Theta is a representation of how the options value changes with the passage of time. So like we said, options decay, so all long options will lose value over time. Theta is going to be negative and is going to be positive for short options since you have the opposite side. Vega represents how the options value will change with respect to a change in implied volatility. All options behave positively with a rise in IV, and it will be, of course, a negative relationships when you're short options. When IV increases, your options portfolio, if you're long, will be increasing and decreasing if IV drops. So this is something pretty important here, right? Positioning is not open interest, right? We're gonna go over the differences between the positioning and open interest. So open interest, what is it? We seem to be using it a lot in our trading and to make our. I used to use it before options depth a lot to place my trades. Basically, open interest is simply the number of open contracts for an option. So we need to understand something is that it is a zero sum game. For every contract, there is a buyer and there is a seller. Right? We're just gonna make up some random positions. So if one person writes the option, meaning selling the option, the other one has to buy it. It can be between any market participant. So two customers can be selling and buying contracts between each other. It can be between a market maker and a customer. It can be anyone, right? What we need to understand is that it is a zero sum game. And open interest is updated once a day before the market open. So let's take this very simple example. Just imagine a market where there's only two person one and person two, right? If person one buys 10 contracts from person two, well, person one is longer 10 contracts. Person two is short 10 contracts. The open interest is 10. Simple so far. So open interest is not a good representation of market makers' position, of any position, actually. Let's dive into this other example. So now we have a market composed of three different market participants. We have customer one, customer two, and we have market makers here as dealers, right? So let's take this first column, right? Day one. This is just an example, one day. So customer one is going to be short 5 contracts. And he sold his contract to customer two. who is long now 5 contracts. The market maker is going to have no position here. The total open interest is going to be 5, as 5 contracts are being distributed here between 2 different market participants. So here, the market maker has no option position, and the open interest is 5. On day 2, for example, customer 1 is going to have 5 contracts. Customer 2 is going to have 0 contracts. And this time, the market maker sold the 5 option contracts to customer 1. So market maker is short 5 contracts. Customer 1 is long 5 contracts. Yet again, the open interest is still 5. So market maker on the first example, he had no option position. The open interest was 5. On the second day, the same 5 contracts were distributed across different market participants. So now the market maker is short 5 contracts and the open interest is 5. On day 3, now something completely different happened where customer 2 sold 5 contracts to the market maker. Now the market maker is long 5 contracts and the open interest is still the same. So we can see that there's no correlation between a specific market participant's position and the open interest. The open interest is only representing the number of open contracts, right? It doesn't tell you who owns this contract. And this is extremely important. So the market maker's position, on the other hand, is going to be representing somehow an imbalance in the options trading, right? Like we said, market makers, they take the opposite hand of customers. They're the one being on the bid and the ask, right? If customers buy a lot, right, of contracts, well, market makers is going to be short, right? They're going to be taking the opposite hand. If the customer is selling a lot of contracts, therefore market makers will be long. It's a zero-sum game somehow. So, like we said, this is the ideal scenario where there's a very balanced trading where customers, trader 1 and trader 2 are equally buying and selling their option contract. And market maker is just playing as a form of middleman, taking the, buying at the bid, selling at the ask, and just distributing the contracts between different customers. This is the ideal environment for market makers. But the reality is that there is often some imbalances, right? On the SPX alone, there's above 20,000 available contracts. So it is very probable that there is some more aggressive buying or selling for some specific contracts. So here is a representation of a buy imbalance, right? Where customers, traders are buying more aggressively contracts, and this is making the market makers who provide the liquidity being short these contracts, right? So there's an imbalance towards the customers. The opposite can be true, where some traders might be selling some contracts very aggressively, and this is causing the market makers to become long some options, right? So it all depends of the overall imbalance in trading. The market maker could be ending with a residual position. So just to recap, open interest represents the open number of contracts. It's like like the name says it, just like implied volatility, meaning that it is a volatility implied in the options price. The open interest is the open number of contract, and it represents just the interests people have in a specific contract. It does not provide any positional insight. So market makers feel the imbalance caused by the customer's trading, right? So market makers, we're going to go over pretty quickly about their roles and also what is at stake. So their role. So right, when you log in on your brokerage account, right, doesn't seem super easy to place a trade, right? You just click on the button and then a random out of the money option gets filled to you instantly and at a fairly reasonable price, right? So behind the scenes, uh, there's a market maker selling you or buying from you a specific contract. So the market makers um, they provide liquidity for our trades. They are typically on the bid and the ask. And without market makers, first of all, you wouldn't be able to place these trades instantly. And also, they help narrow down the spreads, right? Because there's multiple market makers that all compete against each other. So this is helping us get better prices for our trades. So they are narrowing down the spreads, and they provide us liquidity, right? People see market makers as mystical entities, like they want to catch your stop loss, but in reality, they're just trying to survive, right? So, like we said, without market makers, trading would be a complete mess, and it just makes sense that they try to make money, right? They're here to make money, and the way they do it is by profiting from spreads. So they buy at the bid, they buy low, and they sell high at the ask. So scaled on thousands of just on the SPX alone, right? So we said there's about 22,000 available contracts at all times on the SPX. And for each contract, there's thousands of transactions every day, right? So scaling this amount of transactions, if you're able to make $1, $5, $10 on every trade, you can make huge profits, right? And this is how they operate. This is a visual representation, once again, on the Interactive Brokers app. So you can see in pink or red, there's the ask. The best ask is, for instance, 23.2. And the best bid is 22.8, right? So the spread is in between. So it's between 22.9 and 23.10. This is the spread. This is where market makers make profit, right? They're able to sell at 23.2 and buy at 22.8. So buying and selling with these price differences, they're able to generate profit. So the wider the spread, the greater the potential profit. But like we discussed, it's a competitive industry, right? There's multiple market makers and each compete against each other. And therefore, this is helping to narrow down the spreads, and it creates great trading environments for us traders who want to profit and have better fills. So, like we discussed, right, there can be imbalances. So, not all contracts are extremely liquid at all times, meaning that there's not always a buyer and a seller present for every single option contract. Like we discussed, for instance, market makers, like we discussed on the SPX complex, there are like 22,000 available contracts. It's not possible that every single contract has liquidity, buyers and sellers at the same time. So if ever there's a large customer order coming in for a specific contract, well, the market makers will be ending up stuck with the opposite positions, as they're not going to find any other customer to, sell or buy back their options to. So they're acting as the middleman, but if ever there's no other person to transfer their position to, they're just going to stay stuck with a pretty large options position. So this is the imbalance we just covered. And these options positions are inherently risky, right? So if ever they're long options, well, like we discussed, right, with Theta, long options decay, they lose value over time. Short options exposes the market participant to like unlimited risk, right? We're going to dive into this later. So these options, like we said, their pricing is not linear. It moves all the time, and it is extremely risky to be holding huge options position when all you wanted was to profit from the spreads, right? You end up stuck with a time ticking bomb. You don't want that. So a recap: market makers, they provide liquidity for us market participants. We should like them because they make our trading a lot easier. They profit from the spreads. They sell at the ask. They buy at the bid. And overall, options are not all extremely liquid, and therefore market makers and with large option positions. And the red flag here, okay, these options are extremely volatile and their value can fluctuate a lot. So this is risky business for the market makers. Speaking of risk, if there's one thing that they're worried about, like we said, it's not bagging us with our little trades, 10, 20, 100 contracts, right? They have to manage huge risks, speaking hundreds of thousands of contracts at all time, right? So putting things in perspective, an option contract is just like a drop in the ocean. Not only the option market is an ocean, but it's pretty hectic one. Lots of waves, right? So yeah, putting things in perspective, we saw the dynamics of Greeks, right, for a single option contract, but now we can understand that the option market, the market maker's portfolio, can be composed of hundreds of thousands, if not millions, of option contracts, just on the SPX alone, right? And they all move at all time. So this was as of March 12th, right? There was 21,896 contracts and 59 different expirations. We should have a very similar value as of today. But just to put things in perspective, this is the listed contracts. This is not the positions, right? So for each contract, there could be thousands of options in the market maker's book. So we're speaking huge, huge, huge numbers of option contract in the market maker's options portfolio. And like we said, the characteristics of these contracts, they change continuously at the same time and in an independent manner. So we're speaking their value, their actual price value, and also their Greeks, and we're going to dive into it pretty shortly. Like we said, options are volatile, right? And let's not forget, right? The factors that have the most impact are here in red. So during the day, the strike price of an option is not going to change. The put is going to stay put. The call is going to stay call. The dividend is not. There's no dividend for the SPX. Okay. The underlying price though can move a lot. Time always moves forward, and the IV can change for every single option contract. Like we said, so this is the options pricing. So time, there's theta. Time is moving forward. The options value is going to be changing. The underlying price, this is reflected with delta, right? Delta can either go up or down. Sorry, like the underlying price can go up or down, right? And the change in value for the option is going to be reflected with delta. And once again, Vega, it can get tricky. Like we said, every single option has its own IV. It is the fixed strike IV. So it gets a bit more tricky with respect to a change in IV, right? So like we said, the first objective is to not lose money. So like we said, we have three main dangers. We have theta, delta, and Vega, right? Time, underlying price, and Vega. Theta, it's hard to fight, right? Unless you are able to, you have a time machine where you can just press pause. It is hard in some way to hedge. So you can either capitalize from direction. If the market makers are long options, well, they can capitalize from the direction. They could sell decaying assets, right? How they hedge it, there's multiple different ways, but don't forget, here we're trying to find an edge in our market. We're trying to understand what can the market makers do to hedge their portfolio, and if we're able to obtain this form of edge, knowing what they're going to do before they actually do it. So understanding theta is tougher, right? So they could be doing many different things to be able to hedge your portfolio. So moving on to delta, right? Neutralizing the direction, the directional risk of their option portfolio. So they could do what we call delta hedging, right? And that is simply trading, buying or selling the underlying asset. Delta represents the change in the options portfolio value as the underlying price moves up or down, right? And to counterbalance this, they could be buying or selling the underlying asset, as the underlying asset also has a directional risk to it. So buying the underlying asset will have introduced a positive delta to their portfolio, and selling the underlying asset will introduce a negative delta to their portfolio. So they could balance off their delta exposure by buying or selling the underlying asset. And of course, there's Vega hedging. There's many different ways or instruments that market makers can do. Yet again, they could be buying or selling options, different derivative products. Yet again, it is hard to grasp an edge when there are so many different derivative products available on the market. And also, let's not forget, we want to look at the global overall pictures, right? If ever market makers buy or sell options, well, most likely another market maker is going to be on the other side of the trade. It's a zero sum game. We want to understand the overall market maker's exposure, as they're all going to be trading in the same direction, and we could be potentially predicting their hedging activity, right? So, like we said, we're interested in the overall global market maker's position, and there's no particular interest if they just cancel each other out. And like we said, for the delta, they could proceed with what we call the delta hedging, and this would consist in buying or selling the underlying asset. And trading the underlying asset might influence the direction of the underlying asset. If ever there's a huge buying pressure from the market makers, and well, the underlying price might be going up. Yet again, if ever there's a huge selling pressure on the market makers, and the underlying price could be going down, or the ascent of the underlying price could be slowed down if we know that market makers have to sell. So to recap this little section, so market makers, they hold huge amount of options, and these options, they change in value mainly because of time, a change in the underlying price, which uncovers delta hedging, and the change in ID, right? Delta hedging implies trading the underlying asset, and when done in very large volumes, well, this might be moving the underlying. So it's been about 1 hour we've been talking. Do you guys want to continue, or do you guys want to? We can make a little break and answer a couple questions.
Yeah, I think there are questions that are piling up, so it's a good. I think it's a good.
Great.
Yeah,
So
it's a good time to answer them.
Will there be a playback on this? You realize I can't attend anymore. Yes. So this is recorded. So you guys will be able to log in this Crowdcast platform and listen to the recording of this session. What is the key difference between Theta and Charm? Are they the same idea but different names? Great question. We're going to dive into Charm pretty shortly. So Theta represents the decay of the options price over time, whereas Charm is reflecting the change in delta over time. So Theta is a first order Greek, meaning it is a derivative of the options price, right? Charm is a second order derivative, meaning it is a derivative of a derivative, right? So it represents the change in delta as the time moves forward. So this is the key difference. So Charm and Theta are not the same thing at all. So both, however, imply a change in time, right? But they do not measure the same thing at all. Another question here by Dark Sa. So IV is directional. So IV is directional. I thought it was about how much the underlying is going to move, either up or down. So if price goes down a lot, it would also increase IV. So the thing is that there is a correlation between markets going down and the increase in IV, but it is not a causation, right? Um, IV is not necessarily directional, like we explained. Simply an event, having an important event, could be having an impact on the overall implied volatility. So, like I said, IV is not directional. It is not necessarily correlated to the underlying direction. We have very often some days where the implied volatility is going up as well as the underlying asset is going up. VIX up, spot up days. That's just a way to say it. So there is no direct causation between the underlying direction and the IV. There is a correlation, however, that could be maybe explained by the customer's response to a market moving down. More options buying is generally, think of it. If the market starts going down, you would be purchasing some protection, right, for your overall position. Whereas if the market is just going up in a stable manner, there is no need for these for such instances. So, like I said, it is not necessarily directional. It is just a measure of the implied volatility implied from the options price. So, yeah, this was answered. What is the key difference between theta and charm? This we answered. Uh, yeah, Julie Wade said like limit orders, they can vanish. Yeah, I think this was I was speaking of something specific, but I'm not sure what we were referring to. But yeah, some limit orders can be placed and they could vanish, meaning that I could place a limit order at a specific price and just remove that order, and indeed, uh, it would vanish. So how do I know? How do we know if market maker are on the other side of a customer is on or a customer is on the other side? So there's it. Yeah. So let me start answering. So there's different ways. We're gonna dive into this a bit later, but essentially, exchanges know everything. So we're all registered along the SEC, and whenever someone buys or sells an option, exchanges know exactly who buys and sell. You could you could see if a transaction is on the bid or the ask and try to guess is it a customer or a market maker that is long or short. That's one way of estimating it. Another way to do it is the bad way. I mean, it can work sometimes, but it is the least precise is to be assuming that puts are bought and calls are sold by customers, and this is the predominant assumption that is present using open interest. So we don't like this approach, but it could be used and is used by different other providers. So this is answering Min Ski. Can you show how to apply this to ES futures trading, such as entry points going long, short? Thanks. Yes, we're gonna dive into this later. You mentioned Black Scholes, and then you mentioned the one broker who does not use Black Scholes for their delta calculations. Yeah, I mean, yeah, we just use the broker for representing the the spreads. So yeah, they could. There's different models over there, but we'll be using the Black Scholes model for this presentation. So there's One, two, three, four more questions. So the big question is which option contract to buy, strike, then expiry. How can we make this simple? Yeah, we're gonna dive into actionable insights later in the presentation. We're gonna go over how we produce our data sets and how we can use them to place trades. Kind of an advanced question, but why are non-standard call option
Liquid as
non-standard call options not as liquid as a non-standard put option? What do you mean by non-standard? This is answering Jackie Lewis. Stomp hunt can be a way to buy sell the underlying asset to reduce exposure. Uh, yeah, of course. So there's a correlation between ES limit orders and stop orders and the overall exposure. So don't forget, market makers. Now we're covering how they'll be hedging their options portfolio, but there are other ways that they hedge their portfolio, meaning that they also provide liquidity for futures and the underlying asset itself. But in this presentation, we'll be covering how they hedge their options portfolio, which is huge, and hedging can be pretty significant. But yeah, a stop hunt can be a way to hedge their actual underlying asset, definitely. For VIX and meme stocks, IV tends to increase as the underlying increases. That's right, because like we discussed, IV is not necessarily correlated to the direction, rather, it is correlated to an overall imbalance in buying or selling options. So when people are buying options, like you can see here, I'm in hands. If ever we just start buying calls, the overall value of IV of these calls is going to increase as customers are rushing to buy these calls, right? So like we said, uh, meme stocks are a very good example for this. Yeah, so we're gonna dive into the gamma exposure later on. This is for Jeremy Chan. Sorry, I'm curious about the decks and the reaction. What's the advantage of selling 60 delta put call option in the bullish market? It seems like selling 60 delta. Yeah, so we're gonna dive into actionable insights later on in the session. This is just theory. So I'm gonna keep these questions active for later. All right, I'm just gonna take a sip of water or coffee. Are you guys ready to continue? All right, we're gonna proceed with the presentation. Great. So we're gonna go over delta hedging. So like we discussed, market makers they need to hedge their directional exposure. All right, and they proceed with what we call delta hedging. All right, we're gonna go over what it is, how they could do it, and of course, we're gonna dive into the second order Greeks. So what is it? It is used. It is a strategy, like we discussed, used to eliminate directional risk of their options portfolio. So trading the underlying asset is the most popular way to do it. Some of you guys are gonna say they use zero DT options, but like we discussed, right? We want to understand the overall imbalance created. So if ever market makers buy options to hedge your options portfolio, most likely on the other hand will be another market maker who will potentially be hedging via the use of futures. So the goal is to understand the overall imbalance, right? And delta hedging essentially comes down to buying or selling something that has a delta exposure, generally the underlying asset. And when you trade this underlying asset in a very intensive manner, with a substantial imbalance, it can influence the underlying price movements. So the optimal instrument for the SPX would be to be trading ES futures. Why? Well, they're extremely liquid. The payout is linear, meaning that uh, they don't have, like, their delta stays constant. So when you buy a future, if the underlying goes up by 1 point, your profit will go up by 1 point. So it's not, there's no convexity to it like there is in options, and also they do not decay, right? Of course, we're speaking of non-expired future contracts, right? These can be rolled very easily. So the goal is to have a non-decaying delta as an instrument used for hedging. So it wouldn't be very wise to hedge convexity with another instrument that also has more convexity to it. It would just create a mess in one's portfolio. So generally, the optimal instrument is using the underlying itself to hedge the delta exposure. How? Let's just have an example. I love examples. So let's use this following one. So imagine a market where there's only you and a market maker. You buy 10 calls, and I'm the market maker. I sell these 10 calls to you, right? So let's take, for example, this SPX 200 call. The delta is 0.3. Right? So you're in position. You have 10 calls. Your delta is 3, right? So it's 0.3 times your position. So you have a delta of 3. The market maker's position, my position, basically I'm short 10 calls. So my delta is -3, right? So I have the opposite hand of your position. And to neutralize this directional risk, right? Now this is a new trade that is taking place. What would I need to do to make sure that my delta is 0 is to buy 6 ES E-mini contracts. Why? Well, this is just a detail. So one SPX options delta represent $100 change per underlying point change. So there's a 100 multiplicator to options. I think you guys know about it. Whereas ES E-mini contracts, they would change for $50 per underlying point change, right? So there's a 2-to-1 ratio. So if my delta exposure is now -3, I would need to buy 6 E-mini contracts to neutralize it and bring back my delta to 0. So -3 times 2 would be -6. So I would have to long 6 E-mini contracts. So this is just a visualization. So if ever the options book is increasing the delta exposure, what I would need to hedge in the opposite way to bring it back to equilibrium to 0, right? So this is just a little visualization to understand the delta hedging better. So like we can understand, right? As soon as a trade takes place, there is an immediate hedge, right? Like we noticed, as soon as I introduced a new position in my portfolio of a new delta of -3, I had to systematically and immediately hedge, right? So I had to buy 6 ES mini contracts as soon as I had my position, my new contract, my new options position. So generally, even before you see it on the tape on your brokerage account, well, this is already hedged, all right? So, however, so there's no necessarily forward-looking insight. If you're trying to guess if you're like looking at the tape and trying to guess what will be the hedging response of market makers from a large trade, well, I'm sorry to tell you, but the hedging already occurred, right? However, this flow can hint us on, the overall customer sentiment. If we see very huge trades being placed, calls being bought by customers, large transactions on the ask, you can have some good insight on the overall market sentiment, right? The customer sentiment. However, it does not provide you a delta hedging edge in some way. So yes. However, like we said, right, options they change over time, over different parameters, and now time has passed. Price and IV have changed. Now the delta is 0.8. So it was 0.3 before, now it's 0.8, right? So we understand that the delta exposure has changed. So what is going on? Now my delta is of my options portfolio, right, is -8, right? So it was -3, now it's -8. So from the previous state, right, there is a -5 delta that has been introduced to my portfolio. So I'm a market maker and I want to rebalance it once again to zero. So what I need to do as a market maker to hedge my portfolio is to be buying 10 more ES E-mini contracts to bring back my delta exposure to zero. So we understand that it's a two-step process in other way, right? There's an initial hedging that occurs that is systematic, and then there is a continuous battle going on to maintain this delta neutrality in the overall options portfolio. So, like I said, the initial hedge is systematic upon opening a new position, and then the continuous hedging, it varies from firm to firm, right? There's different market makers. So what we know though is that market makers do hedge their option portfolio very frequently throughout the trading session. Some of them is do it with a specific time interval. Others would do it with certain risk boundaries. For example, some firms would do it every seconds, for example, right? But what we do know is that the hedging occurs throughout the day and is pretty systematic and automated. So once again, this is not a calculus class. I don't want to be scaring any one of you guys. But yeah, delta changes. This is all you need to understand from this slide. Don't bother with these complex maths, or computers are going to take care of it for you guys. But what we need to understand is that delta changes. Right? So these are the factor impacting the delta exposure. Similar, right? So they're basically the same parameters that affect the options price. So there's, of course, the strike price, the contract type, whether it's a call or a put, your risk-free rate, which is pretty static, the dividend. There's no dividend for the SPX, but if ever you have a stock, the dividend might be impacting the delta exposure. All these four parameters are generally static during a trading day. Yet there's three parameters that are not very static. So there's the underlying price that changes all the time. It is defined for every single option contract, meaning that the underlying price is the same for all options. However, it is very dynamic, right? SPX, you guys know, moves a lot. Time to expiration, time always moves forward. So it is defined for every single option contract. As far as I know, the time is the same for everyone, moves forward. And it is very dynamic, meaning that the time always moves forward. Implied vol, right? It is not so defined, and it is unique for every single option contract, and it is dynamic for every single option contract on the option chain. So, like we said, delta has a major sensitivity to time. This will be reflected by charm, right? Time only moves forward. The underlying price. So this is going to be reflected by gamma. Underlying price can either go up or down, right? And this can be easily forecasted. If it moves up, we know it moves up, right? And the implied volatility, which is going to be represented by Vana. And this gets more tricky as every single option has its own value of IV. All right. So we discussed previously the first order Greeks. So they look at how premium moves, how the value of an option moves. So there's delta that shows us how the pricing of an option moves as the underlying price moves. There's theta that shows us how the options price changes as time moves on. And there's Vega that shows us how the options price changes as the IV changes. Now, the second order Greek, we're going to dive into the second order Greeks of delta. It is a derivative of a derivative, and making the derivative of delta is going to help us understand how is the delta going to change. Does that make sense so far? You can just put a thumbs up or a yes in the chat. Great. Amazing. So this is a little schematic. So we have the options price. It's like Inception. We have the options price on which we make a derivative. So we get our first order Greeks, delta, theta, vega. We have others, but they're not as interesting. These are the first order Greeks. And then we make a second order derivative once again on delta. So we make another derivative of delta. So we have gamma, charm, and Vana. Right? And these are the main factors that we're going to dive into. So recap so far. Right? Market makers, they profit from spreads. They sell at the ask. They buy at the bid. They have large residual option positions, and these positions are risky. They need to mitigate the risk, notably the directional risk. And for that, what they do is that they trade the underlying by doing delta hedging. They buy and sell the underlying. So if we can know how their delta is going to be changing, we could forecast potential underlying price movements, or at least price behavior. So now the fun part, second order Greeks, right? So there's gamma, charm, and Vana that we're going to dive into. Remember this picture. This is a representation of the delta of an option with respect to the underlying price. Right. So what can we notice here? So like we said, gamma represents the change in delta with respect to a change in underlying price. So gamma is just the derivative. It's just the slope of this graph, basically, right? Just to go show you. Gamma measures the change in delta with a change in underlying price, right? So it is simply a derivative of delta. It measures the slope of delta with the underlying price. So one thing that we can notice is that it is positive. You can see that the slope is positive for a call, and the slope is also positive for a put, right? Gamma is always positive for a long option. So for instance, a put goes from more negative to less negative as the price goes up. The delta of a put goes from more negative to less negative as the price goes up. The slope is still positive, so gamma is still going to be positive. Delta for a call is going to go from almost 0 to more positive towards 1 as the underlying price goes up. So it goes, the slope is still going to be positive, right? So regardless of a put or a call, we're going to have a positive gamma, right? And what we can notice is that the slope increases a lot as we approach the expiration. So you can see here we had the same color scheme. So 1 hour till expiration, the slope is pretty steep. 5 hours, it is not as steep. At expiration, things get very wild, right? It's almost binary. It's delta goes from 0 to 1 real quick, right? And this can be seen on this chart, right? We can notice that gamma is becoming more and more elevated near the strike price and as we approach the expiration time. So, like we said, it is positive for long puts and calls. It is negative only for short positions, right? If you're short an option, a call, or a put, your gamma is going to be negative. And also, it will be peaking at the strike price. And as we get towards the expiration time, it will be increasing exponentially and will be narrowing down near the strike as we approach the expiration, right? And it makes us think about introducing the daily 0DT expirations and how this can impact the market. So just keep that in the back of your mind. So positive, let's just take an example in a positive gamma environment. So like we said, in a positive gamma, an increase in price will be resulting in an increase in delta, right? A market maker in that situation, if he has an option with a positive gamma, if the price increases, his delta is going to be increasing. As a response, his hedging requirement to bring back that delta exposure to zero would be to sell. All right. Similarly, if the price goes down, the delta of the market maker is going to be going down. And as a hedging response, he will be buying. So we can notice that in a positive gamma environment, there is a counter trend hedging flow from the market maker's end. Right? They will be buying and selling against the price movements. Short options get things a little more spicy, right? It is basically the same thing, but you just take the graph and you flip it upside down, right? So now you're short the option, you're short gamma. Same dynamics apply. So as we approach the expiration time, the gamma becomes more and more negative and more concentrated near the strike price. So in a negative gamma, things are more spicy. So as let's say the market maker is short the option now, right? Market maker is short gamma, negative gamma. As the price increases, the delta exposure of the market maker is going to be decreasing. Now, as the price is going up, the market maker has to buy the underlying to hedge. See that? Buys with the direction of the underlying. On the opposite hand, if the price goes down, the market maker's delta exposure is going up. And now the response of the market maker will be to sell on the way down. So you understand that in a negative gamma environment, market makers, they kind of remove liquidity from the market, trading in the same direction of the market, right? Positive gamma is a more liquid environment, meaning that the market makers will be selling and buying against the price movement. And the negative gamma is a complete different scenario. Market makers actually trade with the underlying direction, and it can just add oil to the fire. So we get more volatile underlying price changes in negative gamma environment. Once again, this is just a visual representation. When the options delta is increasing, market makers have to introduce a hedge on the opposite hand, therefore bringing back the overall delta exposure to zero. So this was gamma. Now going to charm. So it will be measuring the change in delta with the passage of time. Right? So this is the difference between theta and charm, right? Theta, like we said, is measuring the change in the options price. as time moves forward, Charm is going to be measuring the change in delta as time moves forward. So a nice way to visualize it is you start at the 5 hours till expiration, and as you move forward, your contract is going to become a 1 hour till expiration. So the way to see it, I put some little arrows here on the figure. So you can see that the five, let's just take the example of an out of the money call. So I'm on the upper left corner of the figure. So you have a 5 hour to expiration call. As time progresses, you're going to notice that your delta, the delta of your call is going to be decreasing. So it's going to go to positive to less positive, right? For an in the money call, your delta, like now I'm in the upper right corner. So your 5 hour till expiration call, the delta is going to go from positive to more positive. So on the left hand side, we had a decrease in the delta exposure. On the right hand side, we had an increase in the delta exposure. All right. Similarly, for a put, we're going to move to the lower section now. So on the left hand side and in the money put, right, you're going to go from negative to more negative. So you have a decrease in your overall delta exposure. And for an out of the money put, it will become more negative to less negative. So we're still going to have an increase in your overall delta exposure. And this can be represented by this, well, this graph, right? We notice very similarly to gamma that charm has no correlation with the actual option type. It is going to be negative for long options below the strike price, and it is going to be positive on above the strike price for long options. And as we approach the expiration time, we're going to notice the effect is going to be more concentrated, more narrowed down near the strike price. At the money, at the strike price, charm's effect is neutral. All right. So this can be seen here, where charm is 0 on the actual strike price. We have some negative charm below the strike price and some positive charm above the strike price. And this is a representation of how the delta of the actual option contract is changing over time. So, in summary for charm, right, it is not dependent on the options type, like we said. Positive above the strike for long options, and negative below the strike. Charm is equal to 0 at the strike price. And just like gamma, the effect is increasing exponentially and narrows down, right, as we approach towards the expiration type. And now, once again, have it in the back of your mind. We have daily 0 DTE options expirations now on SPX. So this effect is going to be very important, right? So once again, if you're short the option, you're just going to flip the chart upside down, and below the strike price, we're going to have a positive charm. Above is going to be negative. So in the positive charm, we like to call it suppressive, right? Because for market makers, this means that the delta exposure of their options portfolio will be increasing as time passes by. So the hedging response will be to be selling the underlying. Negative charm, on the other hand, is supportive, as the delta of the market makers will be decreasing as time passes by, and the actual response of market makers will be to be buying as time marches on. So it's supportive. So think about it is that charm and gamma now have increased sensitivity as we approach towards expiration, and the increased popularity of short dated options, notably 0 DTE contracts, 1 DTE contracts, they exert a huge portion of the overall effect, right? So having daily options expiration is going to have a huge impact on the market makers hedging. Vana, it measures the change in delta as IV is changing. So let's just take this example. So this is a call. On the left hand side, there is calls. On the right hand side, we have puts. Right. This is the same option contract. Right. You have a 7 DTE option contract. On the left hand side, we have a 7 DTE call. Right. In dark blue, we have a call where the IV is equal to 20%. In light blue, we have an IV with 10%. What we can notice is that as the IV increases, whether it's a call or a put, we can notice that above the strike price, we have a decrease in the delta exposure, right? Just like kind of similarly, right? It's a bit similar to charm, right? So above the strike price, we can notice that the 10% IV delta is going to be decreased when we move towards the 20% IV. And for below the strike price, we're going to notice that as the IV is increasing, we get somehow an increase in delta. So this is what we get. So looking at the Vana versus the underlying, okay, we notice that below the strike price, we have a positive Vana, and above the strike price, we have a negative Vana. This is for long options. Don't forget, short options, we always flip this upside down, right? And what we can notice here, I changed the legend. So now the light blue is 1 day till expiration, and dark blue is 7 days till expiration. You notice that the magnitude, whether it is 1 day till expiration or 7 days till expiration, is significant whether we are near the expiration or not. So what we can understand from Vana is that it has an effect, and not only it has an effect, but all options, all expiration will exert a significant impact, a Vana impact, compared to Gamma and Charm, where the short dated options will have the most significant impact. Vana will be driven by the entire options chain. Right. So it is independent once again to the options type. It is going to be positive below the strike and negative above the strike. Vana, just like Charm, is about 0 at the money. And all the expirations will weigh an important role and impact on the overall. So we have some thoughts in the back of our mind. So 0 DTE, right, like we discussed, it has been available to trading since spring 2022. Not necessarily the 0 DTE trading, but just having daily expirations, right? Because we have huge trades taking place that are 1 DTE, for instance, and these trades are often held till expiration, right? So just the fact of having daily expirations is going to have a huge impact on the market makers hedging. Their impact is not only present, but it is growing in magnitude as they're being more and more traded, and Gamma and Charm are going to be as important as they've ever been. All right. So like we said, it will drastically amplify the effect of Gamma and Charm. So we're going to move to a new section. So we're going to dive into our approach. All right. And then how to be able to forecast the market makers' flows. So Youssef is going to take the lead here. Are you able to click and change the slides? I think you're muted. Hold on.
Yeah, no, not on my side, no.
Oh, hold on.
Maybe.
But you're also a host, so that's weird. Oh yeah. Oh, okay, cool. Oh yeah, you're gonna have to skip all the way to.
I'll give you a little break. You've been talking for an hour and a half now, huh?
Yeah, I can't feel my throat anymore.
All right, so where were we?
So, in the meantime, while we reach the good slide, does anyone have, like I said, feel free to ask your question in the Q&A section. And is it clear so far for you guys?
Oh,
Feel free to put a thumbs up or a thumbs down in the comment in the chat section.
I think it did restart. It won't be long, guys. It won't be long. I think you're muted, yes.
Yeah. Judy Wade asked you a question here. Do you calculate net or cumulative gamma? So, interesting question. We're going to dive into our approach very shortly, but understanding that the market makers, they constantly hedge, right? So we do calculate the cumulative gamma for all options contracts of the entire options portfolio of market makers, right? However, we do not use cumulative change in delta, as we understand that there are multiple market makers and they all hedge constantly during the day. So it would not necessarily make sense to have a cumulative change in delta, rather just understanding the momentary gamma exposure at the defined price and time in the trading session would make more sense in that aspect. But it's a very good question. It's actually something we've considered.
All right, so do you see the presentation? Yes, everything's good.
Yeah, applicable uses.
All right. So we'll dive into the applicable uses. In this section, we'll cover our approach, and then we'll talk about forecasting dealer's flow. So let's dive into our unique approach. We really believe that it's a game changer that sets us apart from additional analysis methods. So let's break down step by step how do we approach this issue. So we need to know the market makers' positions. This is our starting point. Once we have the foundation, we can then project how their delta exposure might change under various market conditions. And with this projection in hand, we can subsequently expect their hedging responses to these changes. Finally, with all of this information, we can anticipate potential underlying price behaviors, and this sequential process allows us to build a comprehensive picture of potential market movements, which will give us a significant edge in our trading systems or strategies. So why does proper position data matters? This is the juicy stuff, the proper positioning data. And trust me, this is the secret sauce. You'll see that our data will become your best friend, and it will tremendously help you in setting up your trades and your systems. So, market makers positioning. First of all, you have to know that market makers, in terms of delta hedging, they're like little ninjas, right? They have to be fast, they have to be efficient, and they're always on their toes when it comes to hedging. But if we want to stay ahead of the game, we can just look at their hedging and response afterwards, and we can not look at open interest solely. That's kind of old school. What we need to do is we need to be in their business and tracking their entire portfolio, and look for possible moves. Why do we need to do that? Well, simply because that's how we spot these juicy hedging flows before they happen. So like Elias said previously, open interest has its flaws, and it's about as useful as having a compass that only points to the north, right? It gives you a number, but it doesn't really gives you which way the market's really heading. And as Elias pointed out previously, it lacks the crucial directional aspect needed to completely understand the market's positioning. So imagine you're trying to predict the weather, but instead of having a fancy meteorology setup, all you've got is a wet finger in the air, right? That's what's trying to forecast the market makers' moves without knowing their proper portfolio positioning. But if you know what's in the market maker's portfolio, that's like upgrading from a wet finger to a state-of-the-art weather station, right? Suddenly you're not just guessing, but rather you're forecasting what's about to happen. And to accurately forecast these behaviors, not only we need to understand a market maker's current position, but we also need to see how their exposure might change with different market conditions. And so what we've seen with other services, we've seen a lot of assumptions that were made and that we didn't like. So before we dive into our tools, let's take a moment to understand what are the similar services offering GEX exposure assume, and why do we feel that it's kind of dangerous assumptions to do. First of all, most of them assume that puts are always being bought and that calls are always being sold. Historically, it has some truth to it, because we know that institutions often bought puts as a measure to protect their investment, and they sold calls to protect their to collect premiums. Sorry, but today's reality is far more complex. Matter of fact, we know that some banks offer quantitative investment strategies that are centered around put selling. So that completely contradicts this first assumption. Then there's kind of an oversimplification in these services. What I mean by oversimplification, it's tempting to think that each contract as a simple transaction between one customer and one market maker. However, the truth is far more complex. We're dealing with a web of multiple players, and multiple market makers compete for order flows. So we have customers that are ranging from retail trader to institutional trader to dealers to broker. So we have a whole bunch of participants in the market. It's not just one market maker and one customers doing their exchange. So market makers act as a counterbalancer, offsetting these combined positions of all market participants. Sorry. And combining these simplifications can be dangerous. Why it can be dangerous? Because if you're basing your analysis on false data or wrong positioning, then you might have the wrong pictures in your head, and you're planning on something that's false. So hence the importance of having true and correct market makers positioning to anticipate their hedging. So here in this slide, what we're presenting you is we're presenting you the positioning, the real positioning as compared as open interest, as the open interest. In both cases, you can see around the 4,700 mark, a huge spike. But in the case of the open interest, it doesn't tell you much about the direction of the market, right? It just tells you that it's a level that is really active, but it doesn't tell you if participants are bearish or bullish. Same thing if you go a little down at the 46.75 mark, you can see another big spike, but it doesn't really tell you if it's a bullish or bearish sentiment. If you look on the left side, as you see the positioning, then you can clearly see that one of these two levels, which is the 4,700 mark, is bullish, while the other one is bearish, which gives a huge distinguishment and a better insight. Now here it's two profiles. So basically, you have the gamma exposure, the net gamma exposure of the portfolio of the market makers in red versus the spot price. So you can see as the spot price moves up and down how their net gamma exposure behaves, and in the blue line, it's the same simulation but done with open interest. As you can see, with the open interest, you can see a downward trend as the spot price moves down, and this is majorly due to the assumption made previously. While if you take the positioning profile, then you can see that the profile is completely different and gives you a better insight on what's happening. So here, as you've seen in our posts and on our platform, we offer the gamma exposure heat map. If you look at the heat map based on the open interest assumption, you can see here that there are some positive gamma at the top, some negative gamma at the bottom, and a neutral gamma around the spot price. But if you look at the positioning at the gamma exposure heat map based on the positioning, then the image becomes completely different, and you can depict the options positioning of the market makers a little more clear. So you can see that you have strong positive gamma nodes around the 4740 mark and the 4730 mark, and you have some strong negative nodes at the top and at the bottom of these levels. So now that we know the importance of market makers positioning, how will we project their change in delta exposure? So first of all, as you can see here, it's a chart that we are all accustomed to. It's trading view that presents the candlestick. You can have the price in the vertical axis and the time as in the horizontal axis. So our goal behind this tool is to have present an actionable insight on our trading Canva. So the most logical way is to have the same axis as we use on a daily basis. So have a time axis and a price axis along our tool. And like I said, the end goal is to know when, where, and why market makers will potentially buy or sell, as to be able to set up our strategies and our trade before market open, or at least to know what could happen around certain levels and around certain times of the day. So here, like EDS presented previously, we have gamma that is a change of delta as a change of underlying, which present the whether if the price goes up or down, how would the gamma react? So this is along our y-axis. We have charm, which present the delta as the time advances. So this goes along our horizontal axis. And for Vana, which present the delta as the IV changes, options IV are independent, and it's also very difficult to present it in a Canva that can overlay a price action. So what are the heat maps, and why do we present gamma and charm on the heat map? So basically, heat maps are a projection of how the gamma of the market maker's portfolio will react in both time and price. So the two secondary Greeks that are associated with time and price are gamma and charm. So they rely on the same axis as the candlestick chart, so it makes sense to present them. On the other hand, Vana, well, we need to know the change in IV for each contract, and the change in underlying price or time won't showcase the change in delta of market makers, right? So it's kind of difficult to show it in the same manner as gamma and charm on the heat map. So this just comes to what I said. Okay, now how do we present gamma and how do we project it? So to build our gamma heat map, we first look at each individual contract and their gamma. So here at the top, on the first row, you have the 22,000 contracts, or the 20,000 contracts that are on SPX. And we build a gamma profile versus the spot price. So for the top left, you can see that the gamma has is less wide than the one let's say next to him, and we do the same profiling for all the different contracts. Once we have this profile, we then multiply it by its positioning, and aggregating these contracts will give us a net gamma exposure profile versus it's versus the stock price movement. So let's say that we position ourselves around the 47.40 mark. We can see that if the price moves up a bit, then our gamma will increase a little bit, and if the spot price moves down, then our net gamma exposure will move down. So this approach is really nice if you want to be reactive, right? If you want to look at what's the scenario as we speak, as nothing moves. But in our case, we want to be proactive, and we want to see what the gamma profiles would look like at different times of the day. So we do the same exercise, but we add a time component. We change also the time of expiration of each contract, and we build these different profiles. When it's done, we aggregate them, and that's where the heat map comes at play. So the heat map is simply an aggregation of all these gamma exposure profiles versus the stock price movement. And what it allows us to do is to start the day and know what could happen at different levels, but also at different time of the day. So for this gamma projection, fixed strike IV is used for each contract. There's a projection in time and underlying price, which makes sense and is coherent with what you see on your trading view, on your candlesticks. And for each contract of the market maker's portfolio, it's weighted by its positioning. So it takes a lot of computation to come up with this heat map. So there's no assumption on whether puts or calls are bought or sell, but it's the real positioning that is presented on the exchange that is shown. And I know that some of you guys have asked if we have a heat map that refreshes intradaily. Well, we're happy to tell you that we're working on it, and it should be coming pretty soon. So for the charm projection, it's basically the same thing, but instead of computing the gamma as the spot price moves, we compute charm as spot price moves, and we come up with the same methodology to build the charm heat map. Again, it's based on a fixed strike IV for each contract. There's both a projection in time and in the underlying price, and again, it will be available as part of our intraday subscription as well. So now that we know the market maker's position, how to project their delta exposure, we'll talk a little bit about their expected hedging response.
Great. So I'll be taking the lead here with respect to understanding what will be the hedging response of market makers with respect to different scenarios. So let me just open up my slides. How did you do to open up your slides on your end?
When you want to share, you share slides.
I don't want to share. You share slides. Hold on. Yeah, share something. Slides. Okay, I get it. All right. We have to do this again. Man, this thing is. Hold on. Let's just. Why do we have two? Okay, now it's okay. Hold on. This is yours. Let's just remove it from. This is not the best. Platform is triggering me a bit. I'm not gonna lie. Okay, now I have to scroll all the way back. Oh my god. Well, in the meantime, if you guys have any question, feel free to ask or just leave a comment here in the chat because I have maybe like 1 or 2 minutes of clicking to get to the right slide. Just give me a moment. Yeah, I would expect there to be a go to the page number, but there's
Yeah,
none.
it's
It's just I don't know, man. Maybe they're not. It's not made for such long PowerPoints. How many slides? Like we got like 180. Like pretty big. Reminds
yeah,
me
we
of
should,
university.
those long nights of studying. Eh?
Yeah, nightmares. Yeah. Uh, we appreciate the comments, guys. And if ever you have negative comments, we would love to hear them too.
Yeah.
It's all about being constructive here. So if ever you have something in your mind, don't feel shy. Yeah, the slides are it's pain and let's not say bad words here. Yeah, well, additional tickers. So the thing is that like we discussed, the zero DT aspect of things, the zero DT aspect of SPX is playing a very important, and crucial role, I would say, in gamma and charm, these second order Greeks. So making this analysis on another ticker, we're gonna do it, right? But we're not prioritizing it at the moment. We'll be um, we'll be having we'll be having other tickers in the future, but we'll prioritize having the intraday data in the upcoming update. Oh, and if ever you didn't purchase your 1 year membership and you're currently subscribed to monthly, you can just send us a DM on Discord and we can arrange that for you. There's no problem. So yeah, like we discussed, we aim to have all the tickers in the future. Uh, Not immediately in terms of structuring the servers and the data. We're gonna become like literally Citadel type of level of servers. But yeah, currently it's just the SPX, but we understand a lot of you guys like to trade QQQ and the Nasdaq. So yeah, Nasdaq can be pretty wild, and having such information is pretty interesting. But one thing to understand is that the SPX options are extremely traded by all institutions, um, and um, so the fact that such huge volumes are being traded on the SPX options is partly responsible of the accuracy that we're witnessing. Someone here is asking, I have asked for this before, I shall ask again. Please record a daily video before market open. Not everyone can attend a voice call. It is actually recorded. I don't know if, I think you should be on the Discord, but there is a section in the Discord chat on the complete bottom. It is called recorded sessions. And a couple minutes after we actually do the morning call. I post it in a Google Drive, and you guys should have access to the recordings. And so far, I haven't deleted any, so you could have access to all of the pre-market overviews that we do on a daily basis. Sometimes I'm not available, so I either someone else takes the lead, such as Doc, who is not available today, or I do a text analysis. But usually, almost 4 to 5 times a week, I should be on live on Discord. This is answering Shiva. So if ever you have a question, feel free to just tag me or DM me on Discord, and I'll be glad to assist you. All right, let's get back to it. All right, so we benefited from a little pause here. Time to rest my throat. So now it's about expecting the hedging response of market makers, right? So now Youssef went over how do we project the gamma and the charm exposure across time and underlying price using fixed strike volatility with minimal assumption. Now we want to understand their hedging response, right? At the end, this is what we want to know. So overall, what we need to understand is that market makers delta hedge. If their delta increases, they need to sell the underlying. Simple. If the market makers delta decreases, they need to buy the underlying. Right? That's as simple as that. So, important context. So, first of all, there are multiple market makers. Each may hold a very different position, but us as traders, we want to understand the overall global picture, right? This is our goal. Right. So, let's have a look at gamma and how market makers will be responding with respect to different gamma environments. So in the positive gamma environments, like we previously discussed, right, the hedging flow of market makers will be against the underlying price movements. Whereas in a negative gamma environment, the hedging flow will be with the underlying price movement, right? So, and don't forget that gamma exposure is also not constant. Like everything is moving. Like you have to keep this in mind. Everything is moving. So gamma is not necessarily constant. There's areas where gamma is a lot more concentrated and where this dynamic is going to be more evident, right? So in a positive gamma environment, if gamma is extremely positive, very strong, hedging flows against underlying price movements will be creating some form of support or resistance playing against the underlying price movement. And in the negative gamma environment, if the gamma is very negative, we will have some more volatile price action. All right. So, like we said, high positive gamma environments often yield more constricted price actions, and low gamma environments set the place for wilder price movements. It doesn't mean price has to move, right? If ever the market is just dry, right? It's a holiday or something, there's no market participants trading, doesn't mean it is going to move. However, if there's a lot of volume in a low gamma environment, what it means is that market maker will not be trading against underlying price movement, right? So it will free up the space for wider, quicker underlying price changes. So let's dive into the positive gamma environment. So in a positive gamma environment, it is market makers breathe. Right? There's no urgency. Why? Fairly simple, because the delta is moving with the underlying. So imagine this, right? We said in a positive gamma, right, the delta moves up as the underlying price moves up. So let's say you're at 0, okay? So let's just go in the next slide. Let's have this example here. Right? You see here I kind of circled in yellow. We have blue is positive gamma, right? Meaning that this is how the delta exposure is going to be looking like as the underlying price is moving up. So we understand that the delta exposure is increasing as the underlying price is going up. This is positive gamma, right? Delta increases with the underlying price. So imagine you're a market maker and you are delta hedged, meaning your delta exposure is counterbalanced with your underlying position and your overall delta is now 0, right? You're located here at delta equals 0. If the price starts to increase, your delta is also going up. What does that mean? Potential profits, right? Positive delta means that you can profit from an increase in underlying price. And by effectively hedging your delta constantly, you're able to profit from potential underlying price changes, right? So as your delta increases and the underlying price increases, while the value of your options position increases. So yes, you are going to be delta hedging in the positive gamma environment. However, you're not scared as a market maker, right? You can hedge as you wish. We know that firms do it systematically at a defined rate of time or risk, but just keep in mind, keep this in the back of your mind. So hedging does not have to happen immediately in a positive gamma environment, as there is some form of potential profit to be gained by an underlying price change. And similarly on the downside, so with a positive gamma, we understand that the slope of delta is positive. So when the price goes down, the delta goes down, right? What does that mean? When you have a negative delta, so let's say you are hedged, right? So your delta is 0. As the underlying price starts to go down, your delta is going down. From 0, your delta exposure starts to become negative, meaning that you can profit from a downside move, right? So it only makes sense to understand that in a positive gamma environment, every hedging represents an opportunity to lock in directional profits regardless of the direction, as long as you hedge constantly. So this is a very interesting thing to consider, which is not true in a negative gamma environment where you're actually risking losses and you have to hedge quickly with the direction of the underlying price movement. So in a positive gamma environment, the greater the overall gamma exposure, the greater the probability to witness stronger counter trend hedging flows, the more potential profit there is from hedging activities, right? And the greater odds that the market making firms will hedge, right? When the gamma is peaking, expect some form of hedging to be occurring at this point, right? Because this is an area where not only, well, their delta is going to be changing the most. So in terms of risk, market makers will have to hedge at this moment. Statistically speaking, most market maker will have a very high gamma exposure, meaning that the hedging has to occur near the peak in gamma. But also you need to understand that if you're hedging at the peak in gamma exposure, well, you could profit basically more from any directional move from that point on. So the peaks in gamma exposure, right? They're points of elevated gamma, and these peaks very often will play as a form of support or resistance. Don't forget, positive gamma means that market makers will buy or sell against underlying price movement. So if ever we break above a peak in gamma exposure, we would have less pressure continuing on the upside. Let's say we have it. We're going to dive into examples right right after. But overall, just understand that areas where gamma exposure is peaking is very high, act as a form of support and resistance. And once these areas are broken, well, something that used to be a resistance will turn into a support, and something that used to be a support will turn into a resistance. As gamma is playing both ways, it is simply a reaction. It is depicting the change in delta, right? And the reaction will be market makers hedging against the price movements. So once a level is broken, if the price starts going down, we'll expect some buying pressure that will, whereas resistance will now be acting as a form of support and vice versa. We're going to dive into examples with some heat maps, and you guys will understand exactly what I'm talking about. Naturally speaking, because market makers hedge against price movements in the positive gamma environment, areas of lower gamma often act as what we call path of least resistance. I always say this in my morning videos. So, like I said, the path of least resistance is an area where the gamma exposure is lower. It doesn't mean it has to be negative. It just means that the gamma exposure is lower. Think of it this way. Moving towards an area of higher gamma exposure, we would expect hedging flow against the price movement. So the area of lower resistance, if you want, would be the area where the gamma exposure is the lowest, right? So we're gonna dive into the heat map in the next slide. So we're gonna see in the heat map that the yellow lines on the heat map represents the area of lower gamma exposure that we like to call path of least resistance. This is a very good example. So this was December 22nd, 2023. Okay, this is from our platform. So we can notice the peak in gamma exposure is defined here by the green line. All right. So we understand that this area, this line, represents somehow a level, an area of support or resistance. Understanding that moving towards this green line, we would expect some form of support. If this green line is broken on the downside here, we're going to witness that this area of higher gamma would now play as a level of resistance, which was a support beforehand, right? Now that we're moving up towards this area of higher gamma exposure, we would expect this area to play as a form of resistance. Now pay attention, in a positive gamma, moves do not necessarily happen instantly. We need to understand the story that the candlesticks are telling us, right? Now we can notice that it is slowly being rejected, and near the end of the session, we have a very sharp movement towards the area of lower gamma exposure because we have less pressure to move there, right? Market makers are not as actively buying on the way down as they will be selling on the way up. So this is creating some lower. Think of it like quicksand, right? In a positive gamma, you're like inside quicksand. It's very hard to move. It's like driving your car in mud, right? It's hard to move as market makers will be selling and buying against the direction you're trying to take, right? But in an area of very low gamma exposure, you're on the highway, so there's nothing stopping you from moving more freely. And generally, this area of lower resistance is going to be represented by this yellow line, and it is what we call the path of least resistance. It's the gamma through. Okay, so this is one prime example where in a single day we've witnessed how a peak in gamma exposure and a low in gamma exposure can have an impact on the overall price action. For you guys, I'm gonna be sending you at the end a Discord link if you guys want to join the Discord. And also you will be able to start your free trial on the platform if ever you're not subscribed. Right? So in a negative gamma environment, there's a potential loss, like we discussed, right? As the price goes up, the delta goes down. So what that means is that having a negative delta is a bearish position. Now, as the price is going up, you're actually increasing your downside exposure. So you have urgency to hedge in a negative gamma environment. As the price is going up, as the price is going up, your delta is going down. So you're gaining bearish exposure as the price is going up. This is very bad as a market maker. As the price is going down, your delta is going up. Nonsense, right? Your delta is increasing as the price is going down. The more the price moves down, the more money you're going to be losing, right? You're gaining a positive exposure in a downtrending market. So in a negative gamma environment, things get spicy for market makers, and we're generally witnessing some stronger hedging activity in these environments. So aggressive hedging with the underlying price movement in a negative gamma environment, and we get more explosive, volatile price action. So this is covering the theory and not only the theory, but how you could apply it. We're going to dive into some case studies on the platform in a couple of minutes, but now we're going to move on to charm and understanding the market maker's response with respect to charm. In a positive charm, remember we said positive charm is suppressive, right? So market maker will be selling as oops market makers will be selling as the time passes by. Why? Positive charm, meaning that the delta exposure increases as the time moves forward, meaning that market makers will have to be selling as the time passes by. Negative charm, well, market maker will be buying. Negative charm is supportive, right? As the delta exposure of these market makers will be decreasing over time. Right? And as a response, these market makers will have to be buying as the time is passing by. So generally, during the trading day, the magnitude of charm intraday will be lower than gammas during the trading session. It will be providing uh, some interesting insights on strikes that are pinnable. I'll get into it very shortly. So basically, where let's just jump into the figure directly. I think it's going to be easier. So here for a call or a put, right? We understand that being above the strike price, we get a suppressive charm. All right. This is for long options. Being below the strike price, we get a supportive charm. So we understand that as the price is either slightly above or slightly below the strike price, we're going to get some form of hedging flow that are going to push us towards the actual strike price. If we're above the strike price, we get some suppressive charm, meaning that we get some form of selling pressure by market makers over time. And if we're slightly below the strike price, we get some supportive charm, meaning that the market makers will be buying over time. And this is kind of like pressuring us towards the point zero, basically, right? So don't forget, charm's dynamic is not as powerful as gamma's dynamic in terms of magnitude, and I'm going to show you on the platform how to see this. But it can play some very important impact, just like we've seen in different trading days in the past. And don't forget, you guys have, even though you're not subscribed, you can have access to the platform and see historical data for yourself. We're trying to be as transparent as possible here, right? So going back to the previous slides, the magnitude is lower than gammas during the trading session, and it provides some insights on potential pinnable strikes, just like I described, right? Where we have positive charm above, suppressive, and negative charm below, supportive. And generally, these pinnable strikes are where the market makers are along a lot of options, and generally we get close to them if we're hovering around these strikes near the end of the session. So to have an example in a mathematical way, right? Charm has more effect when, first of all, gamma is very low, right? So think of it like the following way, right? If the overall impact is caused by A being charm and B being gamma, well, if gamma is extremely low or zero, well, understand that the overall impact is going to be driven by charm and vice versa, right? And also near the very, very end of the session, where the hedging flow from charm becomes more important. And don't forget, price can go up or down. Time always moves forward. So charm flows can be more easily predictable with respect to understanding where we're located on the heat map and what is the overall charm exposure. So on the heat map here, we can notice two colors. We have orange and we have blue. Orange is positive charm, meaning it is suppressive. Blue is blue is negative charm, meaning it is supportive. All right. During the trading session, the magnitude of charm is not very high. Right. As we approach the end of the day, we notice that the color becomes more intense, right? The depth of the color represents the magnitude of the value of charm. So dark blue means more negative charm, more supportive, and dark orange means more suppressive, more positive charm, right? And as we can see near the end of the session, as charm becomes more elevated, we get some form of supportive action in the blue area where the price is kind of holding, and some more suppressive action in the orange area where price tends to just fall back. And then we reach out this point of equilibrium, like we discussed, where we have some suppressive charm above and supportive charm below, right? So in the blue, market makers buy, and in the orange, market makers are selling. So we kind of pin around this area. So don't forget, these are days where most of the days gamma is going to have most impact, but as we approach very near the end of the session, we can very often see this dynamic play out. So Vana is more tricky. At the moment, we do not have a tool on the platform. We're working on something pretty interesting. But we're going to dive into the theory of the market maker's response on Vana, like we previously discussed, right? This is very, very tricky. Why? Because every option contract has their own uh, Vana and IV value, right? The IV of every single contract can change independently, right? So it may increase, it may decrease, or just remain static. And market makers, they hold different positions in every contract, right? So it is somehow a mess, computationally speaking. Uh, but we're working on something very cool, and we'll be glad to be sharing this to you guys very shortly. We might be doing a whole presentation on Vana in the future. I think that will be pertinent. But um, like we said, an assumptionless model. We cannot be retrospective. We have something in the works, and we're gonna have a presentation on Vana and how we can use Vana for actual insights. So anticipate the underlying price behavior, trading, right? So first of all, there is the positions. We can understand what position is bullish, what position is bearish. We also have the market makers exposures, so we can understand how the market makers will be hedging, meaning buying or selling as the underlying price moves. In other words, gamma. So this is helping us with understanding where price might potentially go, for instance, towards an area of lower to of high towards low gamma exposure. This is good for directional trading, but also understanding where we have some big walls of high gamma, right? Where price might not be going, where some of our users are selling options beyond these gamma walls, right? And collect premium on a daily basis. So there's multiple different ways of trading using our data, either being directional trader or simply a premium option premium collector. There's different ways of doing it. We're going to dive into some examples where we can understand where or the price will or will not be landing in a trading day. How? Like I said, there's an infinite ways of doing it. You guys are the traders. You're the master of your own craft. You can be using futures. A lot of guys here in a group are using futures to trade. You can use credit spreads, debit spreads, naked options, whatever you want to be able to trade in profit. So I'm going to be sharing my screen right now and hop on the options debt platform and show you some dates with some very particular example where we have positive gamma, negative gamma, and a couple charts with some charm examples. All right. So I'll be closing this huge PowerPoint. All right. So how did you guys like it so far? Amazing. So you guys should be able to see my screen. Um, this is uh, the data for the upcoming trading day. We have an interesting setup. We're going to be diving into some examples that I think are flagrant, right? Uh, Amazing. On this day, we had a user. He made 200 grand. I don't know if you remember, Yusuf. There's this trader who made 200 grand.
That
This
was
was
crazy.
yeah, this was insane. So you guys should be able to see my screen. Do you guys see my mouse?
Yeah, we can see it.
Okay. So on this particular trading day, we can notice different things. On the left hand side, we have the gamma exposure heat map. On the right hand side, we have the 0 DTE customer positioning. So we understand that a selling, just just going on the overall positioning, we have a breakdown by strike of customers position, all right, uh, broken down by calls and puts, right? So generally when you buy a call, like we discussed, it has a bullish outlook. When you sell a call, it has a bearish outlook, but what it means is that the customer is betting that the price is not going to land above the sold call. The customer will profit as long as the underlying price stays below the sold call. When you purchase a put, it has a bearish outlook. When you sell a put, right? When you sell a put, you are betting that the price will stay above the strike price, meaning it has some form of bullish insight. What it means is that customers are betting that the price will not be landing below the given strike price where the put is being sold. So here we had a very interesting setup. We had a heat map with relatively low gamma exposure for a very wide range, and on the downside we had this cloud, this area of high gamma exposure, right? We can understand that in the lower gamma exposure, so don't forget, blue is positive gamma and red is negative gamma. Let me just add the scale for reference. I'm going to be adding the scale on the charts. So here we have positive gamma in blue and negative gamma in red. We understand that light blue means very low gamma exposure, right? And we can understand here that we have lower gamma exposure in this range, right? Until we arrive near the 5190 mark, where we can see that the gamma value is becoming 1000 delta for every 2.5 points, right? Which is becoming kind of significant. We fine-tuned the color scale for what we've been observing as acting as resistance and support levels, right? So we're going to be noticing that as soon as we travel through this area of lower gamma exposure, what happened here, right? We had some form of support. So this can be explained by two different things. The first one is that we hit an area of higher gamma exposure, meaning that as we move down, so yes, it was positive gamma, so meaning that market makers will be buying as the price goes down, but the gamma value was low. So the impact of this hedging was not significant until we reached an area where the gamma exposure is higher. Okay, higher gamma means that the hedging response will be stronger, meaning that we expect some form of support around this area where the gamma exposure is becoming more elevated. The gamma was only peaking lower, right? This is represented by this green line. This is the peak in gamma. But what we can understand is that as we approach into this area, we would expect some form of stronger support. On the right hand side, we can notice that puts starting to becoming sold very heavily by customers. We're speaking thousands and thousands of contracts for every strike price. And this was 0 DTE options. These options were about to expire on the same day. So we understand that these customers which are most likely not retail traders, were betting that the price would stay above the 15,190. Okay. This was the end of the quarter. Keep this in mind. Very strong put selling around this area. And what we can notice is that we had call buying and put selling on multiple different strikes. So this was very bullish positioning overall between the 5190 all the way to 5300. So as we had this move down towards this area of higher gamma exposure, we supported. We moved towards the area of lower gamma exposure represented by this yellow line. Okay. And then we had just an explosion in the underlying price. Don't forget, this was the end of the quarter. And every time we were hitting these peaks in gamma exposure, we had little couple minute, 5 to 6 minute breaks, and then a continuation to the next level and to the next level until the end of the session. So one way to play it was to be selling options below this area of higher gamma exposure, understanding that first of all, market customers are betting that the price is going to stay above. Also understanding that market makers will be buying on the way down. So some people in the chat profited by selling put credit spread. And this guy who made 200K on that day bought a lot of 0DTE options near the close and held for a huge move up. And yeah, he made a huge sum of money. So the date on this was of this chart was May 31st. I'm pretty sure some of you guys remember this day. Another day we had a very interesting setup. I'm just going to take some key examples that are easy to visualize, but the concepts are the same. Whatever day we can pick, we can go over them. But I'm just going to pick some days where we can see this action pretty easily. So we covered here an area of moving towards an area of higher gamma exposure, right? What about now moving towards an area of negative gamma exposure? So let's go on May 1st, 2024. Once again, we had a interesting setup on the downside. This was an FOMC day, and already we had hints that the price action was not going to be going lower. Why? Customers were betting heavily by selling puts from 5,000 all the way down. We're speaking huge positions here. 5,700 contracts. For every single strike price, we're speaking thousands of contracts. This is completely going against the assumption where puts are being bought by customers and calls are being sold. We can see calls are actually being bought and puts are actually being sold. So understand that the assumption of understanding whether puts are being bought and calls are being sold is completely false. So on the right-hand side, we can understand there's a positive position. And on the left-hand side, we can understand there's a negative position. So selling options on the left-hand side by customers and buying options on the right-hand side. So here, when customers sell options, market makers take the opposite hand, right? So they're long options, and this is causing this positive gamma environment. So this is positive gamma from sold puts, meaning that customers are betting that the price is going to land above this area. And also this is causing some positive gamma, meaning that as the price moves down, market makers will be buying the underlying. So we had this kind of support and choppiness. It was FOMC, so we were kind of waiting for the FOMC announcement. And then the announcement happened. What happened here? We crossed into the negative gamma environment. The gamma equals 0, so the gamma flip. We're going to notice we don't have a single gamma flip on our heat maps simply because we do not assume puts are bought and calls are sold. Gamma flips can occur at any time of the day and will be represented by this dark line here. Okay, it is always between a blue and a red area. So we have a gamma flip here. And we can see what happens is that there is some form of readjustment as we cross into the negative environment. Don't forget, we have multiple market makers, right? And their hedging algo, if you want, will be changing as we cross into a different environment. They go from being sellers against the price movements to buyers with the price movements, right? So we have this little 5-minute consolidation here, and then we clearly see that the price action is being supportive, and we land into this negative environment, and look at what happens to the underlying price, right? It just explodes up, right? We just had this huge pump of like 50, 60 points in matter of 30 minutes. And don't forget, negative gamma happens both ways, right? If ever the flow is changing and now there's some more selling pressure, well, expect market maker, if they were buying on the way up, they will be selling on the way down. Right? And we had this we had this dump right after through this negative gamma environment, where we finally had this slowdown in the lower positive gamma environment, where market makers are now turning themselves into buying against their price drop. So this is how we can see and understand the overall dynamics, right, of the market makers hedging in different environments. Okay, so this was another prime example. And what I like to do is also we have this 3D surface, which is just a 3D representation of this heat map. So we can better visualize how high is the gamma exposure and where do we actually cross into the negative. We have this plane here where gamma equals 0, and we can understand that once we cross this plane, we have some more volatile action, right? So one thing I like to give as a analogy is, in a positive gamma, moving towards areas of higher gamma is harder. Imagine that these balls have to rise towards a mountain, right? Towards the mountain peak. It gets harder and harder, right? To go upwards a mountain peak. Think of climbing the Everest, for example. So we will get some selling pressure as the underlying price is going up from the market maker's end. So climbing the mountains is harder, and there's less pressure for the underlying to be moving towards the lower points in gamma exposure. This is just an analogy. So it's not perfect, but it's just a way to understand better these dynamics in play. Right? So I like to use it as a form of heat map. This is why we created the heat map, because we have the x-axis that is common with the y-axis, and we can just understand the color of the background to understand the overall gamma exposure. This is why we use this two-dimensional approach rather than just having gex levels. Not only that, instead of waiting for the gex levels to increase or decrease as we change in price and time, we project it even before it happens, so we can know the critical areas even before we reach them. Right? So this is the overall added value that we have here using this form of heat map. Another time where we had extreme negative gamma exposure was in October 2023. Let's just jump back to this date. So this day was phenomenal. I think I profited very well during this trading day. So we can notice that we were in a very negative gamma environment here. Okay, notably caused by options buying, both calls and puts on the end of customers. What is this causing, right? On the right hand side, we have positive position. On the left hand side, we have negative positions. Right? This is customer position. Okay. So when customer's position is positive, market makers are short options. Right? They have the opposite hand. So all of this 0 DTE options positioning is majorly impacting this overall market makers gamma exposure. Right? We can notice here that the gamma exposure is negative, meaning that the market makers have to buy and sell with the underlying price movement, with the underlying flow. So if ever we have some form of pump towards the upside, well, market makers will be amplifying this pump. We see that we barely have any retracement here. The only time we start seeing a slowdown in the underlying price is when we reach this area of lower negative gamma environment, and here where the gamma actually flips positive. I like to trade these areas of gamma flips for a very simple reason. Whenever we are in negative gamma environment and we want to cross towards a positive gamma environment, think of it as the following. Market makers will go from being buying with the underlying price movements to start selling against the price move. So it's like if you're driving a car and you're like pressing on the gas pedal, and then as soon as you reach this gamma flip where we cross into the positive gamma environment, you press the brakes, right? So this generally acts as a resistance or support level, whether it's on the upside or the downside, and we generally have some form of reversal near these gamma flip lines, right? Gamma equals 0. So think of it as areas of readjustment of the overall delta hedging of market makers. So this was a prime example where we just zoomed through the entire range of negative gamma exposure. We stopped right at the gamma flip, and then near the end of the day, Charm kind of brought us to this. Right, we have suppressive Charm, and we landed right here at the 4310. Right, where we had supportive Charm below and suppressive Charm above. So this was a prime example on how to use options depth data. Another day where we had, let me think. When was, we can just take a random day. Lately we've had this customer on Twitter. I call it the IC man. Yeah, so near the end of the day, we like to look at the charm as it has some more significant impact. Personally, I don't look at charm until the end of the day. Yeah, we can go and see different trading days. We're gonna be looking at, for instance, we're gonna go closer, so that I just show you that I'm not picking specific dates, and this can be applied to any trading day. So let's just go to, some of you guys asked last Friday, so let's just go on this Friday. Let's go on my personal dashboard. By the way, you guys can edit your dashboard as you wish and add the charts of your choice, right? And just place them the way you want on your canvas. So we had this customer placing huge bets lately, 1 DTE bets that he usually rolls whenever he's not right. So Friday was a prime example of that customer failing early in the session, and we're gonna dive into the dynamics in terms of market makers exposure and also the positional aspect of this trade. So here we can notice an iron condor being sold by a very large customer. So he's betting about 8,000 contracts. So selling a call credit spread. So selling the 56.15 calls and buying the 56.20 calls. Similarly, on the downside, this guy is selling the 55.60 puts and buying the 55.55 puts. So we're noticing here that because of this large position, we have a high gamma environment near the 5610 adjacent to a very negative gamma environment. So this short option position by this customer is making this market maker long, hence this positive gamma, and this long option position is causing these negative gamma environments right adjacent, right next to this positive gamma environment, right? Overall, we can see the dynamics, the gamma dynamics that is caused by this position. So above this iron condor, we have some sold options, sold calls. So these customers are betting that the price will be staying below these sold calls. We see that there's a cluster from the 56.40 all the way to like 57.15. Customers are selling a huge amount of calls, right? So they're betting that the price will be staying below the 56.40. So overall, taking this heat map, don't forget, is taking all the expirations, all the positioning and options of market makers, and we're projecting their gamma exposure across the day and across their prices. Here we see a peak in gamma exposure. What did we say about the peaks? They often act as support and resistance, and we tend to move towards the areas of lower gamma exposure, which are the yellow line. So if ever we break this green line, first of all, that means that we have some customer flow, right? Because customers are buying more than market makers are selling. So we were able to cross this peak in gamma exposure. So this hinted us that we will be potentially moving higher, most likely towards the path of least resistance. Also, what we can see is that the critical point of this customer, right, is the 56.15. So he's short 8,000 calls at this particular level. So his pain point is the 56.15. So we mark these two levels, the green line and the 56.15, as crucial levels for a potential squeeze near the end of the day. And this is what exactly happened, right? So as soon as we broke the 5600, we had a move up towards the 56.15 mark, where things kind of consolidated for a while, and then we had a move towards the path of least resistance. Had more resistance moving towards an area of higher gamma, and move back down to the area of path of least resistance. And then as the price moved up in this area of higher gamma, we stayed stuck in near this area of lower gamma environment, right, between these two peaks in gamma exposure. And then as soon as this got breached, we retested the level, the support now turned into a resistance. And we had a user this Friday who made like, on the Discord, he posted his P. Now he made like 65 grand on this drop, right? So the price went down and we were moving very quickly towards the path of least resistance, where we even had negative gamma exposure, which accelerated this move down. And where did the price hold? I mean, it's not magic, it's just math, right? So we held right on the peak in gamma exposure, right? Where we had positive gamma and where the market makers would be buying as the price would be falling into this area, right? So this is how we can use the gamma levels, the gamma dynamics with proper understanding, right? We shouldn't be jumping to conclusions. We should really be using this data to understand the overall market makers dynamics, how they will be responding with respect to a change in time and a change to underlying price. If you've made it through this 3-hour-long webinar on options trading, you're a real one. You're one big step closer to completely change your trading game. You now have two choices. One, use all the information and include it into your current strategies. Or two, join us and have access to our community, tools, and data. Click the link below for a 1-week free trial. I'll see you there. And of course, don't forget to like this video and subscribe for more content on options. Thanks for watching, and I'll see you in the next one.